All right, let's talk about one of the wildest earnings calls of the season, Cracker Barrel's Q4 report. And look, this was not just about the numbers. This was a story about a beloved brand that made a huge misstep, got a ton of backlash, and then had to face the music with Wall Street.
So, right out of the gate, the CEO, Julie Masino, says this. And this quote, well, it pretty much set the tone for the entire call. You knew right away this wasn't going to be a victory lap. This was an apology, a big one, for a strategic decision that really upset their most loyal customers. So, here's how we're going to break this all down. First, we'll hit the actual financial results. Then, the juicy part, the brand backlash that just completely overshadowed everything. After that, we'll get into management's plan to fix it. Fourth, how the market reacted. Spoiler, not well. And finally, we'll give you our take on what to watch for in the next call.
Okay, let's jump right into the numbers. Because on the surface, the quarter looked, well, it's kind of complicated.
You can see the conflict right here. On the one hand, revenue looked great. They beat what the analysts were expecting by about $14 million. But on the other hand, their profitability, what we call adjusted EPS, actually missed the mark. So bottom line, they sold more stuff than expected, but they didn't make as much money on it as Wall Street wanted. And this chart really tells the story of where that split came from. The main restaurant business, it did really well, up a healthy 5.4%. People are definitely still coming in for the biscuits and gravy. But the retail side, that little country store you walk through, that actually slipped a little bit. So yeah, a classic mixed bag. But honestly, those headline numbers, they aren't the real story here. No, the real story is about a branding decision that just went completely off the rails and started a full-on customer revolt. Which brings us to the biggest question of this whole explainer. If the results were just kind of meh, why did the stock get absolutely hammered after the call? What was it that freaked investors out so much? Well, the answer is all right here on this timeline. It all started on August 19th. The company proudly announces this new, modern logo. And the reaction from their customers was, let's just say, not good. It was immediate, and it was loud. By the end of August, traffic had fallen off a cliff, forcing them to do a complete 180 and scrap the whole thing just a few weeks later. And I'm not talking about a small dip here. Management had to admit on the call that traffic fell by about 8% almost overnight after that logo announcement. That is a massive drop. It's a direct line from a marketing decision to a huge financial hit. Okay, so the brand is in crisis mode. They've got an angry customer base. What do you do? Well, management had to act, and they had to act fast. Let's dig into their turnaround plan. It was basically a 3-step emergency brake. Step 1, and this is the most obvious one, bring back the classic old-timer logo that everybody knows and loves. Step 2, pump the brakes on all those store remodels that were part of the modern push. And Step 3, take that money and put it back into the thing that made them famous in the first place, the food. And to back all that up, they're going all in on their roots. We're talking nostalgia marketing, making sure the core menu items like meatloaf are better than ever. And they're going to lean on their huge 9 million member loyalty program. They're even launching this thing called Front Porch Feedback to listen to customers better. Oh, and they're also cleaning house a bit, closing some of their underperforming Maple Street Biscuit spots. So, management has a plan to fix a wound that, let's be honest, was self-inflicted. But the real question is, how did Wall Street react to all this? Let's take a look at the market's verdict. This number pretty much says it all. Right after the call and after-hours trading, the stock just tanked. It dropped by about 10%. The market was clearly not buying the turnaround story just yet, and there's a very specific reason for that. And to get why they reacted so badly, you gotta understand this thing called forward guidance. See, for investors, what a company did last quarter is interesting, but what they think is gonna happen next is way more important. It's all about the future. And this created a total disconnect. It was like management and the market were listening to two completely different calls. Management kept trying to talk about the good stuff. Hey, look at our strong restaurant sales, our big loyalty program. But the market, they were focused on one thing and one thing only. The absolutely awful forecast for the year ahead, where they said traffic could be down another 4 to 7%. That's what sank the stock. So where does this all leave us now? Let's get into our take, what you should be watching for, how we're rating the stock, and one final thought to chew on. Here are the 3 things you absolutely need to keep an eye on.
First, traffic. They're guiding for it to be down 7 to 8% in Q1. Can they stop the bleeding and show some improvement? Second, margins. Can their cost cuts actually keep up with inflation? And third, that loyalty program. Can they actually use those 9 million members to get people back in the door consistently?
Okay, so after looking at all of this, we're initiating our rating on the stock at market perform.
And here's why. It's really a balancing act. On the plus side, management moved really fast to fix a huge mistake. And after that 10% drop, a lot of the bad news is probably already baked into the stock price. The brand took a hit, but it's probably recoverable. But on the minus side, there is a ton of risk here. It's one thing to say you're going to fix traffic, it's another thing entirely to actually do it.
But I want to leave you with one final, kind of out there question to think about. Could this whole disaster actually end up being a good thing for Cracker Barrel in the long run? Think about it. It forced them to slam the brakes on a really expensive, misguided strategy that was pushing away their core audience. By being forced back to their authentic roots, they might have just saved themselves from a much bigger failure down the road. It's definitely something to consider as this story unfolds.
This is not financial advice.